Steve's from Victoria, BC. I'm actually in Victoria right now. I'm in one of the buildings that we just bought. We closed on it about a week and a half ago. Yeah, I know. Yeah, so I'm sitting in one of the units we just purchased. We've got another person in Victoria. We got Nick. Yeah. Cheers, Steve. All right, guys, I think I'm going to get started now. So a lot of people here tonight, which is awesome. So thanks for coming out. I'll be talking about construction financing, and it seems to be a topic that a lot of people want to learn more about. It is a bit confusing and complicated, so I'm going to do my best to explain it to everybody, and I will be answering questions at the end of the presentation. So feel free to use the Q&A. Put any questions into the Q&A that you have, and then at the end of the presentation, I will answer them. This presentation in particular, I have it's a little shorter than some of my other presentations are, so that I have more time at the very end to answer Q&A, especially because there's more specific situations and examples. I also have a tool that I'm happy to send out to everybody that's attending this webinar to help you do an analysis on any construction projects that you're looking at doing. So let's go through a couple of things here. First of all, I'll go through the table of contents. So first of all, I want to talk a little bit about the dream versus reality. And the reason I'm going to bring that up is that a lot of people want to build their own home or build a rental property. There's a dream there. The reality is that it does have one major challenge. And so I'm going to talk a little bit about what that challenge is. I want to explain how construction mortgages work. They are different. I want to talk about the draw schedule, give you an example of how a draw schedule would work, the pros and cons of doing construction, how you can do it. So you can do residential, commercial, or private lending in order to get commercial construction financing financed, how you can get creative, and then a few tips and tricks that I couldn't figure out where else to fit in the presentation. So just little minor things to keep in mind. So first of all, the dream, building your dream house. Everybody feels like they want to do this. They want to build their own home their own way. It's something that a lot of people have on their bucket list of things to do. And of course, a lot of people are thinking about this, what their home is going to look like once it's complete. And what people don't think about is what it's going to look like during the construction and how much work is involved to get there. It's actually quite fun. I've had a number of conversations with husband and wife combos, and they realize how challenging it might be to work with each other because the wife wants these types of countertops and the husband wants these types of countertops, and a lot of decisions that are made along the way in order to build a house. And each one of those decisions takes time, and each one of those decisions is revolving around money, revolving around a budget, and there's very frequent that people go into what are called cost overruns. So actually spending more than you anticipate. In fact, as we will show you a little bit later on, some lenders will include some additional funding for that cost overrun. Some lenders do not, but some lenders make sure that they factor in you spending more money than is in your budget, especially when you're building your own home. For those of you that have built your own home, I'm sure you have this experience. Right now, we're furnishing our own new condo, and my fiance and we went over a budget because then at least she knows exactly what she can spend money on, and then every decision doesn't have to flow through me, especially when it comes to design things. I'm not great at making things look pretty. I'm very good with spreadsheets, however. So we did a spreadsheet, made a budget. Honey, you can spend as much money as you want, as long as it fit, or as much money as you want on these individual items, as long as the total adds up to this. Spend it however you like. But if you go expensive on one thing, you have to cheap out on something else. Perfect. That system works for us. And now she can make any decision that she wants on everything, as long as it fits within the budget. Something that's very relevant, of course, with construction, and it often creates challenges and issues with people that actually run out of cash during their construction. And this poses one major issue or challenge with getting construction financing and being able to build your own home. And that major issue is the amount of cash that you have. With the issue of people running out of money as they go through the construction, the issue of being able to get construction financing at all comes down to how much cash or capital you have available to you to be able to go into this. And so let's talk about how the construction financing itself works. The way that lenders treat the construction loan is based on a cost to complete basis. And so they're releasing money to you in what are called draws, and they're always keeping enough money set aside to finish the entire project if you go belly up. And so one of the ways of envisioning or understanding really how this works is that you're putting value into the project first, and then the lenders are reimbursing you for that value that you've put into the project. And so they're not going to give you a bag full of money and say, hey, please put this into the house, and cross their fingers and hope that you actually put it into the house, and then you don't. That poses a lot of risk for the bank. So they want to know that they're reimbursing you for value that's already been put into it. They really don't want to give you a bag full of money and then find out that you went down to Vegas and put it all in red and black came up. So it's really important to understand that always throughout this construction process, you're putting value into the project, and then the bank says, okay, now we're going to give you another draw. They're effectively, not quite, but effectively reimbursing you for the value that you've put into the construction up to that point. And once the construction is done, then that's when most lenders would then roll you into a regular closed term with the lender. And this is a very important point. Most banks do not like doing construction mortgages. It poses higher risk for them. However, they do like getting the regular mortgage at the very end. And here's the problem or challenge. During construction, if you run out of money during construction, or if you're foreclosed on during the construction and now they have a half-built home that they have to resell somehow, a half-built home is only going to appeal to a very small section of the marketplace. Not a lot of people are going to buy a half-built home, have the means to be able to carry through and actually finish the construction on that project. And so this can pose a major challenge for the banks. And that's why they only like to reimburse you as you move through the process, and also why there's considerably higher risk in getting in construction financing. So I will go into a little bit more detail later in one of my slides about the difference between the different financing options. And one of the concerns or issues is that these are higher risk mortgages for the banks than a standard already built home. In general, in the construction financing, most lenders will go to 75 or 80% loan to cost. And so you notice that I didn't use a term that we often use in the mortgage industry called loan to value. It's actually loan to cost. The lenders will lend based off of the cost of the project, not the future value of the project, which are two different things. In general, you would expect that your cost versus what the future value will be, your cost should be a little less than the future value, meaning that the lenders are not giving you 75 or 80% of the finished value of the product, but just how much money you're putting into it. So your land cost plus your construction cost. I do go into later in the presentation some options to actually build multifamily buildings through Cmhc, and there are options to go all the way up to 100% loan to cost financing in those scenarios, only if you meet certain criteria. So let's go through a couple of items here. So first of all, let's go through a draw schedule and give you an idea of how most lenders set up their draw schedules. I will say this is with an asterisk because every lender has a slightly different way of doing things. But in general, the first draw is at the land stage. You'll find that major developers actually don't usually get financing at the land stage. They just buy land outright. They have enough cash that they keep rolling this over and they'll buy the land outright. And then when they're ready to break ground, they get their first draw. And the reason for that is that they're carrying debt, and there's a large cost of carrying that debt until they're ready to break ground. But for most people, when you're buying building a residential home, for instance, you're usually building on it within a fairly short period of time, or you're buying bare land that's ready to go right now, and you can build on it within a couple of months. And so in these cases, you're getting a land draw. So you buy the land, and in general, the lenders will give you between 50 to 65% of the land value at closing. Some lenders will go up to 75%, but that's quite rare. And in general, if they give you more money up front, it'll mean that they're going to give you less money on subsequent draws. And I'll show you a little bit about how that works actually on the next slide when I should go through an example. In general, the next stage after the land draw is usually at lockup. Sometimes the lenders will have an extra spot in there for foundation, which is about 15% complete. But for the most part, especially in residential construction, lenders will usually do the next draw at lockup stage, which is about 35 to 40% complete. Effectively, you have a foundation, you've put you put up all of your windows, doors, etc., and so no wind would pass through the house is effectively lock up. The next stage is usually where all the electrical and plumbing has already been roughed in and is complete. So that's about 65% complete, give or take. The next one is usually finishing. So most of the finishings work has been completed here, and now you're just putting in minor items at this stage, and usually that's about 85% complete. And then the last stage, of course, is complete. And so what's happening here is you're putting value into the project, and then you reach this milestone, and the lender releases money to you. You'll find that on residential lending, most of the time, these lenders have very strict guidelines on you must be 35 or 40% complete or at this stage before you can get funds released to you. Whereas if you're dealing with a private lender to build your own home, they're more flexible, where you can actually get the draw schedule set up the way that you want. Or if you're dealing with commercial lending, then that's usually where the lenders are a bit more flexible, as long as you get a what's called a quantity surveyor sent out to just determine exactly what costs are remaining to complete that construction of the property. You can get a draw at any point in time. So you don't necessarily need to follow this draw schedule, even if you're building your own home, but you probably will if you want to use a major bank for the financing. They're quite strict upon this. And we actually do have the occasional client that comes to us asking us to bail them out and get a private mortgage to pay out the bank because they got to 33% complete and they ran out of money, and the bank will only release money if they get to 35%. So sometimes people can get through this and stall out. And that's why earlier in the presentation, I mentioned the number one issue for most people is the amount of capital that they have available. It can be a challenge for you to have 35 to 50% down on the land, and then you have to get the property to lockup stage before you get your next draw. And that's often where the peak capital requirement ends up being. It's around that stage in general, not always, but it's usually around that number. So what I have here to give you an example of this, because it's easier to look at a live example. Let's say that you're buying a piece of land for $400,000 and you're going to build something on top of it for $400,000. Okay, so your total value or lending value is $800,000. If the lender is going to give you 75% financing, that means your maximum mortgage or approved mortgage amount will be $600,000. And by the way, all of this is our spreadsheet that we'll be emailing out to all the attendees. If you have no current debt on the property, meaning that you don't already own the property, and you would like a vacant land advance, and you don't already own the land, so you're buying it. So this is assuming that you're purchasing this asset to build upon it. There's a lien holdback, and most lenders will factor in a lien holdback. What a lien holdback is if you do not pay your contractors, then the contractors can put a lien on the property to ensure that they get paid. In general, that lien holdback sticks for, I believe, 60 days after completion. And so the lenders usually hold back the funds for 60 days just to make sure that no liens have shown up on the title. And if no liens have showed up, then they release that extra money to you. So it's just an extra cost or an extra amount of capital you have to factor in and make sure that you're setting aside as you proceed through these draws. So let's go through the situation here and paint a picture for how the money would work. And one item that I've always found missing, and this is something I added into my spreadsheet here, is most lenders' worksheets do not have this far right section, which is net cash position, that you basically how much cash you're out throughout this transaction. It actually pinpoints what your peak capital requirement is. And in most cases, the peak capital requirement is usually to get your property up to lockup stage. So let me show you an example here. You're 0% complete. You've advanced $0 so far. You still have 100% of your construction costs remaining. And so the cost to complete the construction is still $400,000. So the way that the lenders look at this is they say, okay, we will release up to $200,000 to you because you're approved for a total loan of $600,000, and the cost to complete is still $400,000, and so we'll give you $200,000. The math effectively is how much money have you been approved for in the finished product mortgage, minus how much money is required to complete the construction, and how much money has been already advanced, and that's the amount that is available to you to get advanced on this draw. And so to paint a picture for you here, at closing, you're putting $200,000 down on the property, and you get a $200,000 mortgage at closing, and your cost to get to the next draw will be about $160,000. The way that this was worked out is this is an estimate based off of 40%. So you have to get your next stage is to get to 40% complete. 40% of your construction costs is about $160,000. So the lender's giving you $200,000 at closing for the land, and you still have to put $160,000 more into the project to get it to the next stage. And so in total, if I bought the land for $400,000 and the lender gave me $200,000, then my down payment was $200,000. In addition to that, I also need an extra $160,000 to get to lockup stage, is about 40% complete. And so my total net cash position before I get to my next draw is now $360,000. So I know that my peak capital, if I look at this right-hand column here, it looks like my peak capital is going to be about $360,000. And in this draw schedule, depending on the land value and the construction costs, it's not, the peak capital is not always at the lockup stage, but it often becomes this stage. So going through this now, if I'm 40% complete, and so far we've advanced $200,000, the cost to complete the project is still $240,000. And so the lender would look at this and say, well, we need to make sure that we're setting aside enough money to complete your construction. And the amount that you're going to be able to get now is $144,000. So they're giving you $144,000, which is already taking off $16,000 for the lien holdback. I'm going to give you 144 grand, which then gets you to the next stage. One of the things I added into my spreadsheet here is the cost to get to your next draw. And so at least here you can see the bank is giving you $144,000, but it should only cost you about $100,000 to get to the next stage. So now you're actually finally in the construction situation. You're now getting more money on this draw than it requires you to get to the next stage, which is good. So you're now getting more money than you need. And so now you can see the net cash position is starting to improve, because I put $366,000 into it. Then I got a net $144,000 back once I got to lockup stage, and I need to put another $100,000 back into the project. And so now I'm in the hole for $316,000 to get up to 65% complete. And so this continues, and you can see that next stage at 65% complete, I need to put in, I'm going to get a draw for 90,000. And then to get to the next stage, I need 80,000. And then to get to 85% complete, they're going to give me 72,000. And then they need about 60 of that to get to the next stage. And then finally, the last draw, I'm going to receive $54,000, and I'm already done. So my last cash injection to me is $54,000. Now you're going to notice a bit of a difference here. You can see that in the net cash position, I'm in for $240,000. But if we look at this, the total lending value or cost is $800,000, and as a proof for $600,000 mortgage, that should mean that my down payment is $200,000, not $240,000. Keep in mind, the reason for that is that the lender is still holding back $40,000 for the lien holdback, and that money will be released to me a couple months after closing, once they can verify that there are no liens registered against the property. And so ultimately, once all the dust settles, I will be left with a $200,000 down payment in my project. So this is a kind of a high level of how a construction budget would work, and a cost to complete worksheet. This is typically what the lenders will use in order to determine how much financing you can obtain. And you're going to find that depending on the land cost and the building cost, you could see that the peak capital may be at different stages. I highly recommend, because these are complicated. I'll tell you that a lot of mortgage brokers don't know how to use these things and don't know how to work them. I usually suggest that if you do have something where you're looking at wanting to do a construction deal, you should just send over more information about what your land cost, your building cost is. We can work out approximately how much you'd qualify for in the mortgage, and then we can work out a draw schedule for you, and you can make sure that you will have enough capital in order to do this project. Really high level, in general, you need about 40 to 50% of the overall project value in order to do construction. So in this example, for instance, my build cost and my land cost combined are about $800,000. And my total peak capital that I need at one stage of the game here, I need up to $360,000. And in fact, this is not even factoring in my property transfer tax and legal fees that I paid to acquire the land in the first place, et cetera. And so, it really does get up to about, we usually tell clients you should have about 50% of the land plus the building cost in available capital. And I'll say that probably out of, for every 5 clients that inquire about construction, probably 3 to 4 of those clients don't actually have enough capital or were unaware that they required this much capital in order to do a construction draw mortgage. And so this is where things can get a little bit more confusing. Now you can also use this worksheet for commercial construction as well. And in that case, you would instead start to change the draw schedule to just make your own draw schedule. And so one of the benefits of somebody's doing commercial or doing it with a private lender is you can say, well, actually, I'm going to determine when I want draws. If I was to redo this and instead say, I'm going to get a draw at every 20% I complete, it will reduce the peak capital requirement. So in this case, for instance, if I reduced it down to only getting additional draws, but getting it at every 20% completion, then I wouldn't need as much capital to get to my next stage. I would need, instead of an extra 160 at this stage, I'd only need an extra 80. And so I could actually reduce my peak capital from $360,000 to needing my $200,000 down, and then needing an extra $80,000 to go into the deal. And so to get up to 20% complete. So I can reduce my peak capital a little bit that way. So I have a feeling what will happen is when I start to go through the questions, I'm going to probably come back to this and use this as an example to discuss a couple of things. But I just wanted to give everybody an idea of how the draw schedule works. And I hope I haven't lost you. And I've actually noticed the number of participants is still around 160. So I haven't lost you guys, which is awesome. I thought for sure I was going to lose some of you at this stage going through all these numbers, but it seems like you guys are very keen people wanting to stick around and see exactly how construction financing works. So kudos to you. So overall, from a high level, I want to paint a picture for why would you want to do construction? What are the pros? Because of course we've gone through a couple of items here. There are some cons too, but here are the pros. Obviously, you build it your way and you do it your way. You have a bit more control over the project. You will save on contractor markup. So in general, if you're going to buy a finished product from a developer, you're generally going to pay a bit more of a premium to buy that product from them. But if you're actually going to build it yourself, even if you hire a GC, a general contractor, to do the work for you, you're generally going to save a little bit. And one of the things to think about is that in general, I'm going to flip the script a little bit and look at it from a developer's perspective. In the past, a developer would typically look at doing a deal if their margin was between 15 to 20%. So they're going to make on their costs and the amount of capital that they put into the deal between 15 to 20% return on their capital. That means that they're making some money by getting into it and doing a development deal and then selling it to a third party. If you are that person developing it and then selling it to yourself effectively, then you're saving that spread. I will say, however, that I've been noticing that these spreads have definitely decreased quite a bit in the last little while with the rising lumber costs and rising labor costs. And of course, the real estate market being crazy, a little bit harder to make money on the buy right now in this type of climate. And so I've noticed that that the spreads for developers have been coming a little bit more thin. I'm noticing some of my my developer clients are sending me pro formas with a return that's in the high single digits, actually. So it's starting to get a little bit more compressed right now. But regardless, you can generally save some money if you do this yourself and you buy the land and you build it yourself. And so there's a bit more control, of course, to do this as well, because you can buy a piece of land and then decide to build on it 3 years later, 5 years later, or whatever. Whereas if you wanted to buy from a developer, you're gonna have to buy it and close on their terms and deal with their timelines and deal with their way of doing things. So a little less control if you were to buy a third-party product finished by somebody else. A couple of the cons, of course, there's a lot more cash required. You're going to need 40 to 50% of the overall project cost, which is quite the hurdle for a lot of people, especially to build a home in Vancouver or Toronto, et cetera. It's a large sum of money. It's also harder to get the financing. And One of the things we're going to discuss, I think, on the next slide is the challenges that you sometimes find when you're trying to actually get a mortgage on a construction loan. Another thing that people don't like quite a bit is you have to send an appraiser, or if you're doing commercial, a quantity surveyor. You have to hire these people every single time you want to draw. And so in general, it's better to keep your draws to a minimum. The more draws you have, the more times you're paying somebody to go out and do work on your project, and it increases costs, increases the length of time it takes to finish the project, because every time you need to move forward, you're having to rely upon somebody else's information and data, and then that data goes to the bank, who then has to approve it, and then you get your money. And sometimes this can take, weeks. It can really hold up the project, especially if you're not planning in advance. You definitely don't want to be hiring people like your QS or your appraiser when you are at the stage you need to be at. You actually need to be a little bit more ahead of the curve and say, okay, I think I'm going to be at let's say you're building your own home. I think I'm going to be at lockup stage in 2 weeks. We should start to work on getting the appraiser locked down to show up in 2 weeks, make sure that their schedule is available to be there for you. So it's important to make sure that you understand the pros and the cons of doing this on your own. Something that's not addressed here, of course, too, is that yes, you do save a little bit on the developer markup, but you do have to make sure that if you're doing construction yourself, you do have to factor in the interest costs too. You are the one getting the mortgage during the construction, whereas if you're buying a finished product, then the developer who buys the land and gets their own construction financing is the one that's bearing that cost. And so that does get kind of caked into the finished product that you're purchasing if you're buying a pre-sale, for instance, or a spec build from a builder. So let's go through the difference, because there's residential, commercial, and private lending, and I want to go through how these differ a little bit. So residential lending for construction, you're typically getting this through banks, credit unions. Some non-bank lenders also do this. You're typically getting the best rates if you're going through residential lending, and that's usually prime plus 1, sometimes as high as prime plus 2, but a lot of banks are prime plus 1 during the construction. And then once you're finished the construction, they roll you into a mortgage. Note that if you do not roll it into a mortgage, they typically will penalize you in some way. Some banks make you pay a fee up front on the construction, and then they reimburse you once you've rolled into a 5-year fixed term or some kind of term with them. A couple of lenders will actually give you a regular mortgage rate right off the bat to jump into a construction loan. So you actually aren't in a prime plus 1 scenario during the construction. You go right into a more competitive close term right off the bat. But most banks do put you into a spot where you're at prime plus 1 during the construction with interest only payments until you're finished the project, and then you roll into a regular mortgage, and then you choose a term that you want. They usually want you to roll into at least a 3, some of these even 5-year term once you're finished the construction. And sometimes they won't actually allow you to go into a variable rate either. It has to be a fixed rate, something to keep in mind. They do have the tightest underwriting policies, especially for construction. So one of the challenges is that there are a lot of products out there in the marketplace, like if you're self-employed, there's stated income or corporate net income programs that can help you qualify if you don't have enough income on paper. There are net worth programs available, for instance. A lot of these programs are not available for construction. Most construction loans require you to income qualify. There's a couple of other challenges too, where sometimes the lenders say, well, while you're building your home, we also need to make sure that you can debt service you paying rent somewhere else, because you still have to pay to live somewhere while you're building your house. And so that can be a challenge of certain banks that are a bit stickier on that. Another item that can come up too is if you're building a home that has a basement suite in it, then the lenders often will not include the basement suite income of the house. And again, this is where different lenders will or will not use it. And so long story short, it is harder to get construction financing, especially if you're self-employed or if you generally need to fit into some kind of unique program. They are harder to fit in into construction. Not to say that it's impossible, but it's just less options available for you. Like any residential financing, is still very client focused. And so they're looking at your personal income, your personal net worth, your credit score, et cetera, like most residential policies are. And in general, they're moderately property focused, so they still like to see that you're building a decent product in a decent area, but they're more client focused on their underwriting policies. The reason I bring this up is that that residential lenders, like major banks, they will go to smaller towns where sometimes you'll find that that private lenders, for instance, are more property focused and less focused on the client, which some of this is good, some of this is not good, and I'll get into that in a second. One other item on residential is that they do prefer owner occupied as well. They can do construction. Some lenders on residential can do construction for rental properties in a holding company, but a lot of lenders, as soon as you do construction in a holding company name, that becomes a commercial deal instead of a residential deal. And so what is commercial when you're building underneath the commercial side of things? You're still getting these funds typically through banks, credit unions, non-bank lenders. There's a lot of large non-bank lenders that are big in the commercial space and construction space. Prime plus one is possible. Prime plus two is kind of the standard for construction for most banks pricing right now. There's usually a fee of anywhere to 1 to something as high as 2%. It really depends on the lender and if you're using a broker or not. A lot of the time, that's where your total fees might add up to be about 2%. There is a bit more flexibility with the borrower itself on the commercial, so they just like to see that the credit and income makes sense. But the underwriting is more focused on the property and it's more project based. So what is the profit margin? Do you have pre-sales or not, et cetera? So let me explain a little bit about commercial financing for construction for those of you that are considering doing this or are doing this. What they're often looking at is, what is the feasibility of the project? What is the profit margin of the project? If the profit margin is very thin, then they won't have as good of a feeling of doing that deal as they would if the profit margin was thick. They like to lend to people that have experience. So it's very difficult to get brand new builders financing with a major bank. In fact, sometimes what you have to do is actually use private lenders at a higher cost to do your first few projects, get those under your belt, and now you can go to a bank and say, hey, look, I've finished 3 successful projects. Here was my total cost. Here was my turnaround time on the project. Here was the total profit. And if you have a really good layout for your previous projects, which is what we typically deliver to the banks whenever we're selling a commercial construction deal to a bank, you just make sure you package it up really, really well to show prior history and prior success on other projects. That's what banks often like to see. On the pre-sale side of things, they generally like to see that you're pre-selling units. Some banks are very picky on this and they require you to have 50% of your project pre-sold. Some are even higher than that in different climates, depending on the type of market that we're in. And some lenders, for instance, will say, well, we'll do 2 properties max on spec. And spec means that you're building it and you haven't pre-sold it yet. And so you're hoping that you build them and the buyers will come. And so different lenders will have different policies on this, but long story short, in general, a lot of banks will want to see that you're pre-selling up to, or sometimes even more than 50% of your project if you're building stuff on the commercial side of things. Something to keep in mind. Usually will go up to 75% loan to cost in commercial financing, but there are ways that you guys can actually get up to 100% loan to cost financing through entities like Cmhc if you meet certain criteria. And so if a certain percentage of your building is 30%, I think it's 20% of your units are 30% below the median rents in that market, then the Cmhc may approve your building because you're fulfilling a need in the marketplace of providing low income housing to the community. And so we find that certain markets are very good for this. You can find that Cmhc, something is really, really good for certain markets and not very good for certain markets. But the overall way that we position a lot of these deals on the commercial side is if we can position it so that the loan amount that we're getting would be serviced by the income of the asset. And so if I can position it and say, look, once this property is built, the income coming in is 1.25 times all of the expenses of the property. That's what's called the debt coverage ratio, or DCR for short. If I can say that the DCR is 1.25 or higher, meaning that the income totally covers off all the expenses for the finished product value that we're looking at, then it's easier to position this and pitch it to a bank to actually get the financing on it. So that's often how we do this, especially if we don't have any units pre-sold, because we say, hey, bank, if they don't sell the units, then they'll just hold on to them and they cash flow positive and they put money in the borrower's jeans. And so they're more likely to consider something in that type of climate. And of course, there's privates. So this would be MICs, which stands for Mortgage Investment Corporations or private lenders. And in general, this is where you have higher rates. So that's usually between 6 to as high as 12% interest. Generally speaking, most of the residential stuff with private lenders usually ends up being between 7.5% to 8.5%. A lot of the private lenders that we've been dealing with are around the 7.5% to 8% range, to give you an idea. The fees usually are around 2.5% to maybe 3%, somewhere in that range. Occasionally, if it's a really strong deal, some of these fees can be as low as a total of 2%. The one benefit here is that there's minimal client underwriting. And so they do look at the borrower and they want to understand what their history is and and who the builder is, but you're not going to run into as many challenges or problems here, because usually the lenders, the private lenders that do construction usually have a construction background. And so their thoughts or feelings are that if you stopped during the construction, that they have a crew they could use to just take over the project, and they have familiarity with how to get these things across the finish line. That's why you find that a lot of private lenders or MICs don't do construction at all, because they don't have that background or connections. And some of them do construction because they figure, somebody just belly up, they put a lot of money into the project and I'll just take it over and I'll finish it up and sell it myself. And so that's why on the private lending side, they're almost entirely property focused. And this is where it can be good or bad, because if they're property focused and you're trying to get construction financing in a small town in BC, Alberta, or wherever in the country for that matter, smaller towns are going to be much riskier assets to the bank. There's way less buyers in those markets, and the property can sit on the market for a lot longer. Not to mention, if you're doing construction in a small market like that, how are you going to be able to easily get a crew out to that market to finish it? A lot of these lenders are located in major urban centers. And so if the lender is in Vancouver and they have a crew that they know and can work with in Vancouver to finish projects, if something goes sideways, what are the chances that they can send that crew out to a small town of 5,000 people, right? And hey, would you mind finishing up this home that we lent on and had to foreclose on in Timbuktu, with a population of 2,500 people in northern BC, where it gets really cold all year round? I'm sure your crew would love going up there. So it's a lot more difficult for you to get financing through private lenders in small towns. But you're going to find that they're very good for major urban centers where the borrower might be a bit trickier to finance, or a lot of our guys that are in construction will actually use private lenders just simply because they're way easier. Getting a bank approval can take a few months, and that's often the case. It usually is not a quick process, and so going through a commercial lender being that slow is quite prohibitive, especially in a market like this. We're often telling our clients, if you're writing offers right now, be prepared to close with the private lending or cash, because at least that way you can write a more competitive offer. And you have to close with a private lender, no problem, just close with them. And then eventually, once you're ready to break ground and you get your development permit, then we roll you into a commercial loan, use that land draw to pay off the private loan, and then you get rolling with a commercial lender, which is going to be cheaper than the private. So essentially, there's the three different routes you can take to get the financing, and it kind of depends on which bucket you fit into, what type of asset you're building, what your personal situation looks like, and sometimes even comes down to timing, how much time you have. So getting creative and trying to think outside the box. Let's say that you're trying to figure out, like, I don't really fit into any of these boxes, or I don't have enough cash or whatnot. One of the strategies that we've used is actually hiring a builder to just build for you. It's surprising how many times people say, I want to buy want to build my own home. That's awesome. But why don't you just enter into an agreement with the builder to buy the piece of land that you want, and enter into a pre-sale agreement with them to buy the finished product? So what happens then is, instead of you buying the land and then getting construction financing on it, you say, hey, builder, I would like that piece of land, and I would like you to build this on that piece of land. And the builder says, great, I'll buy the land, enter into a contract with the individual to sell a finished product to them at a prescribed price. The buyer puts up a sizable deposit, usually 10% or more. In fact, it's more common to see, 15 or 20%. And that just gives the builder some comfort that if the buyer walks away from this contract, once the house is built, you say, hey, your house is built, here you go. And the buyer says, actually, we're going to do something else. That deposit is a buffer. So then at least the developer or the builder could say, well, okay, I'll find somebody else that I can sell this home to at a discount and at least get my money back. And it allows the buyer to get a traditional mortgage. So we're talking about how much capital is required to do construction. You can do a purchase of a built product with as little as 5% down if it's your own residence. And so this allows people to still do a minimal amount of down payment and to get a regular mortgage on this property, even though they still custom built their home. Of course, if you do this, the builder paying for the cost of buying the land, property transfer tax, interest costs, the additional risk, they're going to build in a bit more of a buffer. And so you're going to pay a bit more than you would if you just bought it and were able to go through the construction financing yourself. But it still makes a lot more sense. If you don't have that as an option, you can still have your own home built for you without having to qualify for a construction mortgage. And in many cases, it's much easier for a builder to qualify for a construction mortgage because they've done this over and over and over again. They probably have a relationship with the bank to do these, whereas you do not. Another option is to use cash or HELOC to build. And so this is where you'd be leveraging other real estate to do this. And so you go to your existing home, let's say, and say, okay, I'm going to get a big home equity line of credit secured against that, and use that to just fund my construction. And the benefit of this is that then you're not having to go and get a construction mortgage approval from the bank. You'll get better financing because a line of credit just on your home for regular use is prime plus 0.5, or sometimes even better than that. You don't need to deal with the banks for getting draws, and so you have to reach milestones, arrange an appraiser to go to the property, send that over to the bank, wait until they've approved you, give you money, and then keep going. You just write checks as you need to, using your line of credit or cash, of course. And don't forget, you can, once you're finished the project, you can still just refinance the property once it's complete and use that to pay off your line of credit, right? And so we always suggest make sure that you reach out to us, because a lot of lenders right now will not remove the line of credit balance from the debt servicing. So even lenders that don't use your line of credit limit, they use your line of credit balance to determine your debt service ratio for residential lending. Even if you're refinancing to pay off that balance, they will still keep that amount owing as if you're borrowing that money on the debt servicing. And so we do recommend that if you're intending on using this option and you're planning on refinancing the finished product once you're done, you should still run it by us just to make sure that there is a lender that would allow you to do that and you'd be able to qualify to do that. So tips and tricks. These are, just some details that I didn't know where else to fit into the presentation. So I'm going to fit them in here. One item that I really wanted to address and talk about today is the capital gains. And this is what a lot of builders will do, is they'll actually build their own home every couple of years, and they'll go in, move into it, live in it for, minimum. And in general, this depends on who you talk to accounting wise. And frankly, there is a gray area here with the CRA, but in general, you hear about 12 months is how long minimum you should be living in the home before you sell it and do this again. But still, the CRA is definitely cracking down on this and ensuring that people aren't just building and then moving into the home to avoid having to pay tax. But keep in mind, a personal residence does not have any capital gains. And so if you build your own home, that little buffer that I talked about, or if you hired somebody else, third party, to build a home for you and you bought the finished product versus building it yourself, well, guess what? Not only are you saving on that amount of money, but on top of that, that amount that you saved is not subject to capital gains. And so that extra 10 to 20% over and above the costs that you did not pay would not be subject to tax when you sell the property. And so I do know a few builders that every couple of years they build a new home for themselves, move into it for a period of time, and then sell it and then do this all over again. And that's a way of making tax-free income. We talked a little bit about this, which is saving on the costs and the builder margins. So I did talk about builder margins and the fact that in general, building the product yourself is usually about a 10 to 20% margin caked into that deal. And so there's some margins to be had there if you're willing and able to do construction yourself. One thing I want to bring up here, because sometimes we have clients that mention this. If you have an existing home and have a mortgage on it, if you tear down that home without informing the bank, you are in breach of your mortgage contract. So we do have this occasionally where sometimes people will say, okay, I'm going to buy a property. I'll get a regular mortgage on it now. And then when I'm ready to actually break ground, then I'll restructure the mortgage. And just so you know, those mortgages are different. So a mortgage for an existing home is one bucket of funds or one pool of funds. A mortgage for construction is a different bucket. What that means is that if you're intending on buying an existing home and then building on it in a couple of years, and you want to get higher leverage, because of course you don't want to put 50% down on the land value and have a much smaller mortgage. You probably want to get more leverage and put just 20% down on a house, you kind of standard 80% financing mortgage. Keep in mind that when you are ready to go into construction, if you just tear down the home and start building on it without informing the bank, then you're in breach of mortgage contract and they can call the loan. Or if you go and inform the bank, then they will say, well, now you're moving into construction mortgage. We have to break you out of your current mortgage you have and go into a construction mortgage. And you're going to break it, pay a penalty if you're in a closed term, and then move you into construction, which is a higher interest rate. So it's important to understand that. Also, keep in mind that when they move you into construction mortgage, they might say, well, we're only giving you 50% of the land value for your construction mortgage. If you got 80% of the land plus the house value earlier, you're probably having to pay down your mortgage by a substantial amount just to move it into construction. And then on top of that, after you've paid into it to reduce it to the amount allowable for a construction mortgage, then you have to put more money into it just to bring it up to lockup stage or whatever stage you need to. So it's important to understand that it's not as simple as just getting a regular residential mortgage and then switching into construction mortgage later. If that is your intention, I highly recommend, if it's 1+ years out, go into a closed variable mortgage on the house acquisition. That way your penalty will only be 3 months interest. Don't go into a fixed rate mortgage because the penalty could be 5 to 10 times more expensive than what the variable rate penalty would be if you do break it to go into construction. I do want to address that you can get up to 100% financing for Cmhc insured construction. So that would be something that's 5 units or more, and it must be residential units. Cmhc does not insure like industrial builds, et cetera. If you are building multi-purpose where there's residential and above commercial, the commercial typically cannot be more than 20% of the overall square footage or overall value of the building. But you can do it where you have 10 stories and the first story, for instance, is retail, and then the other 9 stories are all residential. And you can get up to 100% loan to cost financing. Now, again, one key there is it's very difficult to get that because 100% financing, you'd still need the income coming in to be 1.25 times all of the expenses on the project, which is quite difficult in most communities for you to borrow all of the money to build it and yet still have all of your expenses covered off. But it is feasible and possible for you to get up to 100% financing. So something to keep in mind. Another note here too, Cmhc financing is cheaper rates than regular residential or commercial. So it's even cheaper money than what you typically get elsewhere. One thing I want to mention is lenders don't like lending on bare land. Bare land is not appealable or appealing to the vast majority of the marketplace. And so that's something that you need to keep in mind. They don't like financing bare land. So generally speaking, if you're trying to get major bank financing and you just have a piece of land right now, you should be having to, or you should be preparing your plans, your budget, your drawings, et cetera, and positioning it as a construction mortgage so you can get financing on it at the land stage, because they're going to say, okay, we're going to give you a construction mortgage, what they draw at the land stage. So just keep that in mind, that if you're just buying a piece of land, most banks will not give you a loan on just bare land. There's a couple of credit unions that occasionally can give you a loan on bare land as long as you meet certain criteria, but it's quite rare and difficult today. And one point that I mentioned earlier is that residential lenders usually require you to be income qualified in order to qualify for the mortgage. So that's something that you do need to keep in mind, that special programs don't really exist, or at least it's much more difficult for construction than it is for a regular mortgage. That might be another reason why you need to look at something else. So overall, I'm hoping that that this information was beneficial. Green Mortgage Team is here to help you build your dream home or an apartment building or whatever the heck you're trying to build. So we're always here to help you with that. On our website, we have a lot of cool tools. We do that spreadsheet that I had a snapshot of earlier, the cost to complete spreadsheet, we will be sending out to all attendees. We have other things on our website too, like our investor survival guide. There's a couple of links to our upcoming webinars on November 3rd. So again, it's always the first Wednesday of every month at 7 p.m. Our commercial lending webinar is on November 3rd. And then on December 1st, I'll be talking about financing renovations. And so I'll be going over a couple of things there. Anytime you want to learn more, you can book a consult with us. You can go to our website and fill in our form, and we'd be happy to reach out and connect with you to see if we can help. And there's always creative ways. We're very creative with how we can structure financing. For those of you that don't know, I am a Amazon bestseller. I wrote I've actually been in 2 different books, but my most recent book was Rockstar Real Estate Investing. We talk a lot about a number of different things. One of the cool chapters in that book was the $1 condo, we called it, where if you bought a condo, put money into it to fix it up, and then refinanced it and refinanced for the total cost of your project, you effectively could own that condo with just $1 in it. So it's a very common and very popular chapter that is kind of relatable to what we've been discussing here with regards to construction financing. Anybody that does not have a copy of that book that would like a copy, feel free to email us at info@greenmortgageteam.ca. We're happy to send you a copy of that. It gives you a lot of information about the fundamentals of investing in real estate and whatnot. So that concludes me talking and spilling my guts all about construction financing. I can see that I still went 50 minutes talking about construction financing, and I promised you guys that it would be a shorter presentation, but I think I got stuck on a couple of slides and went really deep with it. But hopefully, it was valuable information. I will start to go through the Q&A and answer those questions, and then I'll start once those are all finished. I'll start to go through the chat and answer any questions that were left in the chat and not in the Q&A. Okay, so let me just open up the Zoom chats here. Okay, so the first question is, can you watch the recorded Zoom? And yes, yeah, we're going to have a recording of this all up on our website, so you'll be able to check that. It usually takes about 2 days before the recording is up. Okay, so one of the questions here from Steve is, does the 50% dollar amount needed still apply to large builds, so multi-story builds in the tens of millions? And so, generally speaking, Steve, no, it's a little less if the land value is lower proportional to the entire project value. In addition to that, on commercial, you're usually able to get draws more frequently as long as you hire a QS or quantity surveyor to go out and do it each time. So it's not as efficient to do that. You'll find that many banks will still have a cap on the number of draws that you can do, but the 50% number is usually more applicable for residential, your typical residential deal, where the land value, especially in like Greater Vancouver, for instance, the land value is as much or more than the total build cost. Whereas usually, if you're getting into large builds, like the tens of millions, usually the land is a smaller footprint compared to the number of square feet that you're building. If you're building up, of course. So it's a general rule of thumb for residential, but it doesn't quite apply in commercial. That's where you could use the cost to complete spreadsheet to do an analysis on it. Adele had a question. So what if you're clear title on the house and slap a line of credit on it and then tear it down? Gray area, but seems appealing. So I did address this a little bit, where technically if you do that, you're in breach of your mortgage contract. Will the bank find out about it? I mean, banking isn't what it used to be, 20, 30 years ago, you may have known the branch manager, and that branch manager made all the decisions ultimately at the end of the day. And they might be driving by Adele's house and they say, wait a second, wasn't that Adele's house? I just see a piece of dirt now. So it's unlikely that would happen nowadays. Everything seems to be centralized, and the chances of them finding out is pretty slim. But technically, you're in breach of contract to do this, and so you're doing that at your own risk. But technically, yes, you're playing in the gray area, but it probably would make for an easier process for you, because you're not having to get construction draw mortgage or anything like that. It'd be easier to get financing. Ron has a question. Hi, I have a property in Florida that I own, just land. Do you have any contacts for construction mortgages in Florida? Not off the top of my head, Ron, but I do have brokers that are located in the US. And so I'd be happy to do an introduction. If you just send us an email, we can send you some contacts for US mortgage brokers and see if they can help you. Anonymous question here. Do you guys do business financing? And yes, we do. I have a commercial division and a residential division. My commercial division handles business financing. Because we're mortgage brokers, of course, a lot of our stuff that we do in our office is usually tied to real estate, but not all of it is. And so we've done a lot of business financing for people looking at raising capital for their business, raising money, even for we've done it for some builders who needed some extra capital to finish some projects. We've got some unsecured money based off of the financials of their corporate entity. And so the way that company financing works is, in general, they like to point to cash flow wherever the cash flow is, or they like to point to performing assets. In general, we usually find that we'll be looking at the financial statements of the company, determining how much financing that company can achieve, and then getting financing set up against that. One major difference is that in general, rates are a bit higher because the security is not as good as having a piece of real estate that they can point to and sell if needed. Number one. Number two, as the borrower, the term of the loan is usually shorter. So a lot of the time, the term is 3, 5, 7, or maybe 10 years maximum for a term on that type of loan. And so you're going to see that your payments are much higher on business financing than it is for a secured loan. Benjamin has a question. Is the book free? Yes, it's free. Don't worry. You don't have to pay, 10 or 15 bucks or whatever it is on Amazon. I call it a really expensive business card, but yeah, I'd like to give it out to people that attend the webinars. I think that there's some good stuff in there that you can learn, especially if you're learning how to invest in real estate and starting from the ground up. A lot of foundational information in there, and most people will be able to pick out a thing or two at least that they found very interesting. So email us and we'll with your mailing address, and we'd be happy to put one in the mail and send it over to you. Tanvir has a question. So how long does it take for you to get approved for a residential, commercial, and private loan? Exactly. So on residential, that really varies. About 1 to 2 weeks is standard for a residential if you have everything that you need for the bank. And I will say this, a lot of the time you do not immediately have everything that you need for the bank. And so timelines can be a bit longer. But I would say that 1 week is a short timeline. 2 weeks is kind of the average, maybe 2 to 3 weeks, something I would say maybe is the average. Again, that's if you have everything that you need and you're ready to submit to underwriting. The challenge a lot of the time is that you write an offer on a piece of dirt with subject removal, and then you start to go to the architect, you get your drawings, then you get your budget created after talking to your general contractor to get that GC agreement signed. A lot of things that happen. And during that process, we'll work on gathering up what we can, like the income documentation, your down payment, all that other stuff. But it takes some time for the other things to fall into place. And so the date that we have everything, usually 2 weeks on average, sometimes 1 on extreme circumstances, sometimes 3. Really depends on the lender and on you. Ian has a question. What is the rough ballpark or cost estimate, cost per square foot estimate for a custom built home in Alberta? Good question. It's actually something I thought about including in the presentation, but decided that can vary quite a bit. One of the things that we look at is what the quality of the home is, and so we can see that this can vary quite a bit. We have some people that are building homes for 150 bucks a square foot, which is rather cheap. That would be on the low end of the range for sure. Most of the stuff that I see is between $200 to $220 a square foot for reasonable quality. And then it can really go up. I mean, I've seen, high quality stuff for about $250 a square foot. You also see high quality stuff go for, $400 or $500 a square foot. So it can really start to skyrocket, depending on whether you're importing that marble from Italy or where you're getting it from. So it really depends on the situation. But I would say that usually 200 to 220 a square foot is good for your typical like average home in general. Sometimes they can be as low as 280, sometimes they can be as high as 250. So that would be kind of the wider range. There would be 180 to 250, but most stuff is 200 to 220, I would say. Ryan has a question, just to clarify, if a parcel of land already, I need to have the buildings plans ready to qualify for construction loan. Yes, you do. So Ryan, what happens is we need to be able to go to the bank and say, this is what the finished product will look like. And then an appraiser needs to appraise the finished product and say, this home, if it's built to these specifications, will be valued at this much, because the lender will only give you 75 or maybe 80% of the finished product value. But we don't know what the finished product is going to look like until you have those plans and a budget and everything created. So that's where there's a bit of a chicken before the egg situation. If you have a parcel of land and you want financing on it, it's generally difficult to get bank financing on it until you have your plans and your budget and drawings and everything done. But if you need some quick cash secured against it as a bridge loan or whatnot, you could get a private lender to potentially give you some money in the meantime. All right, Angela has a question. If we own the land already with an older house and it's zoned for a duplex, how does that position us for financing? So the good thing is your older home, the home value doesn't really get factored in when you move into a construction mortgage. So the way that the lender would look at this is they would say, okay, your first draw is based off of X% of the value of the land. And if the land value, according to the appraiser, is higher because the zoning is approved for duplex, that means that your land value might be higher because of that circumstance. And so we do find that that could help you. Keep in mind, Angela, that it still does not remove the requirement for you to have enough borrowing power to be able to do the construction. So yeah. And thanks, Jean. Nice to see you. It's been a long time. Brent mentioned, with commercial and pre-sales, do you basically need to have purchased the land then? So maybe just to clarify this question. So if you're trying to get a commercial approval, because I'm assuming you're probably referencing the timelines that I mentioned earlier. In general, with commercial and getting pre-sales and whatnot, yes, it's generally quite difficult to get bank financing on these things. Sometimes you'll find that in these types of situations, you'll either have one of two things happen. You'll either buy it with a really long close and you're working with the seller, and the seller will allow you to go to the city on their behalf. And so it's almost like you have not quite power of attorney, but you effectively can make decisions on behalf of the landowner in that situation, even though the title doesn't change hands. Sometimes the landowner will carry a vendor take back mortgage, or sometimes you'll close and go private with it. But it can be difficult for you to get financing past a certain point. Sometimes the banks will still give you the land drop, but they won't give you the financing to break ground until you have your units pre-sold. So it just depends on a couple of factors. But that's again where a lot of big builders, they're buying the land outright with cash, and then they're working on their on their permitting, they're working on getting pre-sold, et cetera, and then they go to the bank with a package. John has a question. Is it possible to get builder mortgage with a numbered company registered in BC? Yes, it is. You'll still, if you're going through residential lending, you're still personally guaranteeing it. If you're going through commercial, you're likely still guaranteeing it because that numbered company probably does not have any assets in it, which means that there's no real strength coming from that company. And so, yes, you can get a builder mortgage in a company name. Different banks are more lenient or less lenient with that. Some lenders say if it's in a company name, that it has to be a commercial mortgage because it's a business loan. Some lenders, however, still do it on the residential side. So there's a couple of major banks that we typically work with for those loans. And Ron, you're mentioning that your cost to build is about 900K. I'm sorry, I don't remember what the previous question was, but maybe if you just retype out the full question, then I can answer that for you. Tanvir, I've seen homes go on the market, sometimes 50% complete. How easy is it to get financing in a home under construction by an owner or builder? Quite difficult, actually. So in general, major banks do not like to touch half-built homes. Private lenders, sometimes they'll consider it, but there's always concern. If somebody got to a certain stage and ran out of money, the concern is that they started to cut corners. I'll give you an example, actually. Myself and some investors bought a fourplex in Edmonton about 3 or 4 years ago. And we bought it, we're like pretty much complete. We got a construction crew to come in, wrap up the building. We only needed to finish up about 10% of the building. No problem, right? Until we tried to turn on the water. We realized, what the heck? Why is the water only turning on in one of the units or two of the units? I can't remember. I think it may have been half of the building. So eventually what we ended up having to do is we started looking into it. We couldn't figure out why this wasn't working. We dug underneath the front lawn, and there's a huge excavator now. And by the way, our costs are skyrocketing now. To figure out what's going on. Why is the water not working? Because our water line seems to be connected on our end. We went underneath and they got almost to the point where they connected the water, but they skimped out and they decided not to just add that extra 6 feet or so to connect to the city water line for the other half of the house. And this is because they basically ran out of money and they said, F it, we'll just fill it in, put all the dirt on top of it and not finish it and not tell anybody. And guess what? You try to sue these guys, you're going to spend more money trying to sue them than it just costs you to dig up the front lawn. So the problem is that in many of these situations, people are starting to run out of money. They start to cut corners, and banks usually don't want to get caught in a situation like that. Private lenders are a little bit more willing to consider that. But it is harder for sure to purchase a half-built home. And again, this is where it's kind of a self-fulfilling prophecy, where because the banks will not provide financing to these types of things, it also hurts them more if they're providing construction financing to somebody and then that person goes banco or goes belly up, because now if they foreclose on that and they need to resell the property to somebody else, there's not a lot of buyers available because nobody can get financing on it because other banks are doing the same thing they are, which is not providing financing to half-built homes. So it's kind of an interesting circumstance. And Angela, so I think you're mentioning probably 1 million for your land and 1 million for the building. So yeah, you're in an interesting spot if your property's zoned for duplex. Ideally, in your situation, Angela, if your home is clearly on one half of the line and you can just subdivide and then build a home on the other side, then that's probably the ideal circumstance, if you can do that and pull that off. But if you have to tear down $1 million home to build on the duplex lot, I don't know if that would absolutely make sense. You'd have to run some numbers on that. You'd have to have a really high profit margin on the construction of the duplex for it to make financial sense for you to tear down a home that's still worth $1 million. It probably makes sense to just let the home slowly deteriorate over time, and probably a number of years later, eventually then you tear it down. But that could be 30 or 40 years before that home is in shape where it makes sense to actually tear down. Question about holdbacks. Is this automatic by the lenders, or do the builders have to sign agreeing to a holdback? So it's pretty much an automatic by the lenders, because it's not up to the builder. Keep in mind, there's a general contractor, but that general contractor might not be paying his subs or his trades underneath him. And so even if you and your general contractor agree that this is how you're doing it, this is still potentially an issue where a sub could still put the lien on the property because they were not paid by the GC. So it's common practice for the bank to assume about a 10% lien holdback. Hey, Rajat, question. Hi, Kyle, clarifying on builder's margin, referring to the spreadsheet example, 400 grand land and 400 grand construction, about 15% approximately for the builder margin. That 15% would usually be on the total cost. And so that would be on the $800,000 number. And so you would expect that your profit margin would be about 120 grand, meaning that if you bought a piece of land for 400, built a $400,000 home on it, that you would expect that the finished product would be worth about close to $920,000, give or take, maybe $900,000 in this current climate. But it is on the total cost typically. Good question. Pooja has a question. Hello, Kyle. What if I already have land, a home on it, but I don't want to build entirely new, but want to keep the foundation and add addition to the current home? Would that be an issue for the existing mortgage lender too? So technically, yes. If you're changing the property structurally, then the lender would want to know about that, and you could be in breach of the contract. It's a bit more of a gray area, and you could probably play dumb to that. But you may want to inquire with the bank before you do anything like that. But technically, if you're changing the structure of the building in any way, then the bank would say that they'd want to know about that. As an example, if I'm sending you to a bank and I'm saying, hey, the client wants to do renovations, the bank usually asks what do you want to do. If I tell the bank that Pooja's going to go, yeah, they're gonna tear down half the home, they're going to do a huge addition to the home, the bank's going to say, oh no, we're not doing that as a regular residential mortgage. That client needs to go into a construction mortgage now. And so they might do it on a construction loan, but they probably wouldn't want to know or hear that you're intending on doing that and want to keep your regular residential mortgage. So just keep that in mind. If you're changing the structural integrity of the building, then they're going to want that to be in a construction mortgage. Okay, Surov, what are the CMHC criteria to lend on construction properties? Do they lend on all kinds of properties? So no, so CMHC only lends on residential, like so multifamily buildings. It has to be 5+ units. No more than 20% of the building footprint or income can be coming from the commercial component. So if you have retail, you can have residential above, but you can't have more than above retail or commercial, but you can't have more than 20% of the square footage or income come from the commercial component. And then in general, for CMHC to get involved in the construction side of things, there's special programs or specific programs that you'd have to fall into. If you send me an email, it's probably easier for me to actually send you the product guides because there's a ton of stuff to go through. But there's a lot of criteria that you need to follow in order to get CMHC financing. But I can tell you that the developers and builders that we worked with that we were able to get CMHC financing for, it's very, very lucrative. It is much more difficult of a process to get approved through CMHC. The timelines right now are about 12 to 14 weeks to get the file picked up, and there's a lot of criteria that you need to hit, but the interest rates are well worth it. Mira has a question. If you buy the land with either private money or a VTB, a vendor take-back mortgage, does that impact the construction financing step? So buying a residential 5-unit property in a smaller urban center. So what you could do is you could buy the land with private money or a vendor take back. And then once you're ready to break ground, then you can have the construction mortgage kick in. The first draw on the land value would then be used to pay off the existing mortgage. And then you would just get the property up to lockup stage. And then at that point, the bank's next draw would kick in and they gave you the next draw. So you can do that as long as you're starting with the major bank before you break ground is ideal for the bank. They don't want you to break ground, get to a certain point and then go to them later. They like to start at the beginning, or sometimes you can get it up to lockup stage and then start that process. But it's always better to get the bank involved before you break ground. Ideally, getting a private mortgage or a VTB on the land acquisition does not negatively impact you. In fact, that's quite commonplace. Adele has a question. Is the max HELOC 65 or is it 80%? Good question. So the maximum amount you can borrow against your home strictly on a home equity line of credit is 65%. However, you can still get total financing of 80% secured by the property as long as no more than 65% of its line of credit. And then extra 15% would be on a secured term loan. So you'd have to have a mortgage or an amortized portion for that extra 15%. But combined, you go 65 plus 15, and that would be the full 80% financing. So you can still get a HELOC product up to 80%, but inside of the 80% financing, at least 15% has to be a mortgage term. Tyler asks, if you own the land and there's no mortgage on it, do you still need a deposit for the build financing, or how does that work? So no, if you already own the land, then you could get a draw in the beginning for up to 50% of the land value, and you could use that to then get you up to the lockup stage. And that's an area where people that already own land, that's commonplace, where they'll just get their first draw against the property that they own outright. and then they use those funds to get them up to the lockup stage. And then the lockup stage draw gives them the money to get up to the plumbing and electrical rough-in, et cetera. And then they continue that way. And so for a lot of our clients, especially larger builders, they usually try to buy the land with cash outright, get to the development permit stage, and then they get a draw on the land, use that money to get to the next stage, and then they kind of go through the entire process. But you can do the same thing too. You don't have to put any extra money into it. If you already own it outright, you'd be actually getting money out instead of having to put money into it. Stephanie asks, hi, Stephanie, how are you doing? Is there always a personal guarantee component to a commercial construction mortgage? Almost always, Stephanie. It's very difficult for you to get away from a personal guarantee. In general, the company has to be strong enough where the bank will say, okay, we don't need a personal guarantee from that individual because the corporate guarantee is strong enough. I can tell you I don't even know, we've funded probably 3,200 or 3,500 mortgages or something like that in my 15-year career. And I think I've only done 2 mortgages without a personal guarantee, to put things in perspective. And those 2 were companies with 100 million revenues per year, et cetera. So very, very large corporate entities that were very strong on their own accord. Zara asks, for commercial builders, can the quantity survey be done in-house, or does one need to hire a third-party quantity surveyor? Typically, it's a third party. It's pretty rare that the bank's going to allow for you to have an in-house individual, but that is very bank dependent. I think that if that was the situation, then we would probably go to the bank and ask for an exception to see if they would allow for that. Probably depends on who the QS is as well. Pooja asks, how does your team determine how much money would be needed to construct a home? That's where we'd use that cost to complete spreadsheet that I showed earlier in the presentation. We'd put in the cost to build, the land value, what you're qualified for in the mortgage, and then it would reverse engineer how much money you would need in order to construct a home. But in general, your target should be close to 50% of the overall project cost. The land plus the build cost is typically what you would need. Grant asks, assume you can best to combine private and bank construction financing to acquire and then develop and build on land. Do you have spreadsheets that include financing and interest carrying costs? Also, if larger development, so syndicate group of investors, do you have any suggestions on how to incorporate financing of project with debt and equity partners with different returns and traditional banks? Yeah, so long story short, I think what you're looking for, Grant, is like a pro forma to run numbers on doing construction. And I do have a couple of spreadsheets that might be handy for that. There's a few different ones depending on the type of project too. So if you email me, I have a couple of spreadsheets that, some that are ranging from fairly simple to use and some that are way more complex that you could use. So send me an email, Grant, and I'd be happy to send you over what I have. And I have, again, varying pro formas for that. Zira, so for commercial, I think I answered this one already. I'm not sure why it popped up again. Cool. That one's done, and thanks for clarifying. So this is just mentioning, if you're building something and the land cost is 400 grand and the build cost is 400 grand, so the total is $800,000. Then I think that you're looking at, so 15% of 800 grand would actually be $120,000. And so the peak investment of a 360 grand cash on cash would be about 25 to 26% return. Okay, so I think I know what you're saying here. So I think you're referencing the total profit, and so slightly different calculations. I think what I would do, Rajat, is I have a couple of things that I'll email over to you, and I'll go over some details with you on that to show you what the exact returns would be with getting into a construction deal. All right, and I gather that the Cmhc forms are very extensive to fill out. Could you do a webinar on that? Yeah, I already have a couple of things. I'm starting to plan out my my webinars for next year, but I know that this is something that some people are interested in. To be completely frank, these types of deals are very, when we talk about residential lending in particular, it's pretty straightforward, black and white, can put a stamp on. It's pretty easy to do. I usually say for construction mortgages, especially CMHC deals, they're usually bigger, larger, and more complicated. I think that would be more of like a one-on-one conversation. So if you have something that you're interested in discussing, then I think you should just email me, Zara, and I'd be happy to have a conversation about filling that out and discussing that. So cool. So that was all of the Q&As, and I can see that I have 82 things in the chat. So I'm just going to rifle through these and see if there's anything else that people ask questions in here that I didn't have a chance to answer. Let's take a look here. All right. Somebody asked if there's a recording available. Yes, within about 2 days, the recording will be available on our website, and we usually email the recording out in about 2 days. Let's see here. That's good. A couple of people actually mentioned that that the conversation about the draw schedule is clear, which is good. So that was good, because those types of conversations can sometimes be a little bit confusing. But I think the spreadsheet, what you'll find is a lot of the lender spreadsheets for the cost of complete basis don't have some of the extra fields that I added in, aka how much money does it take for you to get to your next draw, and also what's the amount of capital that you've put into the project so far to date. That makes it a bit more challenging and difficult to understand how much capital you need throughout the project. Ian is just mentioning that you went through the construction process and had to submit 37 different documents to get approved. Yeah, sounds about right. It's not simple. I've got another question on in the Q&A here. So Christian is asking, what about financing for prefab homes? Will prefab companies finance construction? So it's a little bit different here. So prefab, the challenge sometimes is that prefabs all arrive almost all at once. And so it can mess up the draw schedule a little bit. There's usually the land, and then there's the foundation. And then all of a sudden, almost the entire finished product shows up at once. And so the draw schedules get a bit mixed up. What you'll find is that sometimes the prefab companies will actually work with your draw schedule a little bit, where they say, okay, give us money at the beginning when you get the land draw, give us money when you get your foundation draw. And then when our product shows up and we're about 85% complete, approximately, give or take, then give us another large draw at that point. And then when we're at 100% complete, give us another draw. So some of the prefab companies will be more willing to work within the bank's confinements of how they finance their construction. But this actually is a bit of a challenge depending on the company, where they may not be willing and able to put a ton of money into the prefab to deliver it unless you've given them a large enough deposit to do so. And the problem is that your capital requirements may be much steeper if you literally are at foundation, which is about 15% complete, and then they're delivering effectively a finished product and plopping it down on the foundation. Well, now you go from about 15% complete to about 85% complete immediately. Well, you're probably not going to have enough cash to do that 70% of your entire construction budget in one shot. So yeah, that can be a bit more of a challenge, but I do find that a lot of the companies that of the contracts I've been seeing, either they are preset and they're working a bit more within the confinements of how banks like to do these, or we've had it where we talk to our clients, get in touch with the builder, and then just work with the builder and say, hey, look, this is how the client needs it to be. And then we work out some kind of agreement. It doesn't always work out that way, but I've been finding that they've been more reasonable with that lately. All right. A couple of other people mentioned that they'd like to recording the discussion. Yep, and so that's gonna be hosted and sent to everybody shortly. Let's see here. Any other questions that people had here? Okay, cool. Steve, financing renos, nice. Yeah, that's one that that comes up quite often, is how do we finance our renovations? And there's different ways of doing that. It's a simple conversation, but something to look at. Deirdre has a question. Is this book on Audible? Not yet. Maybe I just don't like hearing the sound of my own voice, but I have not yet recorded my book on Audible. That's something we've considered doing, but we haven't gotten around to it yet. Let's see here. Any other questions? A couple of people are mentioning, where can you get your hands on that book? I'm just going to pop in a note here for the book, or for questions, email info@greenmortgageteam.ca. For the book, make sure to include your mailing address. You would be surprised how many times we have people emailing and saying, hey, I'd like a copy of the book. And we say, okay, great. Let us know where your mailing address is. And they say, yeah, my email's here. I'm like, yeah, but it's a physical book. So we need to physically mail the book to you. So we need your physical mailing address. So just make sure if you want the copy of the book, make sure you send out send us your physical mailing address so that we know where to send the book. Thanks, Angela. Yeah, it was, it's timely because I found a lot of people right now are interested in building their own home. You're stuck at home more frequently because of COVID. And so we have a lot more people inquiring. And to be completely frank, I was surprised how many people signed up for this webinar. It was one of our best or most well-attended webinars that we've done so far. And I knew that it was a topic that people wanted to learn a little bit more about, but I was a bit surprised that we'd had this many people on it. So I'm glad that you guys decided to come out tonight. Okay, so there's another question about acquiring properties that are in foreclosure or in probate or auction. So yeah, those are options. If they're also health-built, then of course they're very difficult to finance. That's something that's more of a case-by-case basis. But the process for buying a foreclosure or buying a estate sale or an auction, those are all very different types of transactions, and so that would be a bit more specific or unique. I will say this: I remember seeing a presentation years ago by somebody that did a lot of foreclosures, and I think the stat was that in foreclosure, the home sells on average for 3% less than the market value would have been. And I don't know where they got that data from, but for the fact that it's a lot more difficult to go through that foreclosure process, it didn't seem like it was a lot of money to me to be saving. But of course, 3% on $1 million is still a decent amount of money, but it was not as much as I thought it would have been. Ricky had a question. Just wonder how much percentage the builder charges if you hire a builder to build it for you and then buy it from the builder. That really depends, but that's generally that profit margin that we talked about, that extra 10% of the costs, 10 to 15%. And we just had a couple of people that would like the real estate book sent to them, so that's awesome. Yep, happy to do that. And let's see here. June also has a question. I took a Vancouver course on buying high equity businesses with other people's money and to finance out. Can you do any part of these deals over $5 million? Yeah, so very interesting. We've had a couple of people that buy underperforming businesses and then turn them over, increase scale by adding technology, et cetera, to those businesses, and then refinance and take their cash out once they've improved the net operating income of the business. It's a very cool business model. So something that I'd be more than happy to jump into. I'm very intrigued by those deals. Anytime they come across my desk, I always love digging into them. So it's doable. It is difficult in practice, of course, to do exactly what you want, aka to pull all of the purchase price back out in debt and then do it over and over and over again. But it is technically possible. But there's certain things that you run into. I think one of the biggest challenges we find is that the banks want to know who the buyers of this business are. And if you're not going to have an agreement with the existing owners to remain employees for a certain period of time, usually for a couple of years, and you don't have experience in a specific industry, then a lot of the time the banks aren't as keen on helping you finance that acquisition. So that's often a concern there. David has a question about where does private hard money or bridge loan fit into this process? And so often that's often in the entire process of buying the land and then going through construction, or sometimes just at the land acquisition stage. But often, especially for developers, it's at the land acquisition stage just to land bank it and hold it until they're ready to break ground and they have development permit, and then they switch it into construction mortgage. That's where we see a lot. Or residential clients that can't qualify for many different reasons to do construction, but they can qualify once the product is finished. And so they often will get into construction and do that, or flips. One area that is difficult if you're doing residential flips and you want to do this as a business and you want to do it in an operating company name. An operating company is a lower tax bracket than a holding company. Holding company is about 50.7% tax. Operating company is about 11.5% tax or 10.5% tax. Much different tax bracket, of course. And so the objective often is to do it in an operating company name, especially if you're continuing to do these over and over again. The tough part is residential lenders won't do construction for an operating company. They'll only do it for a holding company. And then for the commercial lenders, if you can't get commercial financing because you don't have enough of a history or background, it may make sense for you to actually use a private lender and go with the financing in your operating company name, because you're going to pay way less in tax. And sure, you pay more in interest, but the savings on the tax size outweighs the interest in the increase to the interest costs. So that's often where private lenders can be very beneficial. Human had a quick Q&A. I sent an email with my mailing address for the book and happy even to come to the office to pick up the book. I read the Kindle version of the book and would like to have a hard copy. Is a keeper in my personal real estate book library. Thanks, Human. Yeah, just send an email to my team and we'll arrange for that. If you'd like to come pick it up and say hi, that'd be awesome. If not, we're happy to mail it to you. So just send us an email and looking forward to that. Let's see here. Another question is, June has a potential 36 unit multifamily that I showed it at about 50% of retail, but lots of issues to fix and stabilize. Any chance you can help with the equity, as this is not lendable until it's completed and rented. June, I think you should send me an email with more details about that project, and I'd be happy to take a look at it, but I need to really dig into the numbers and see what that looks like. Sometimes that's where private lenders can be more flexible. If you present a really solid exit strategy, so in commercial real estate, if you can pitch a really good exit strategy and to improve the NOI, the net operating income, and it looks like you could refinance the property with an A lender once all that is done to pay out the private lender, that can be a good exit strategy. And Steve is saying, is that a good strategy to target, I wonder? And yes, yes, I would say yes. Although maybe your Steve Rent mentioned, you may be actually addressing, Steve, buying half-built builds with cash and then finishing to sell and rent. That is possible, as long as you don't get caught with challenges or problems that I, for instance, ran into. Steve, could be a good strategy, but at higher risk for sure. We're looking into, okay, cool. Let's see here, just going through any other notes or questions so that I can make sure everybody's questions are answered today. Nick has a question. I have a condo in Victoria and recently bought a house in Duncan I live in. Both the properties are revenue generating. Not sure if this would help me with the next mortgage, considering my debt service ratio or refinancing would help. Yeah, so Nick, that's a longer conversation because it depends on exactly how much income is coming in from those properties. But I will say the lenders will use that rental income. Different lenders use different percentages of that rental income. So some lenders, in particular banks, might use only 50% of the rent. Credit unions might use 50, 80 or even 90% of that rental income to help you qualify. So that's where we can help you. We shop about 40 different lenders to figure out which lender has the best product, best rate. And for real estate investors, honestly, the most important thing usually is who can give you the most money. And so we'd be more than happy to take a look at that for you. If you send us an email with some more information or call us, then we'd be happy to help you with that. Colin has a note here. Much of the examples given is about land value equal to build price. How about an example of 100 grand in land value and a 400 grand build for residential? Do the numbers in the first draws work on any different? So they do, Colin. The numbers would change a little bit if it's 100 grand in land value. What actually ends up happening is if I change the worksheet here and only have 100 grand land cost, actually do here is I'll share my screen with you. So I've changed now my land cost to $100,000 and my building cost is $400,000. And now what happens is at the land stage, for instance, there's so much money required still to finish the construction. The approved mortgage is only 375, but my cost to complete is still 400,000. So in this case, there's actually no money available to advance at the land draw. You'd actually have to buy the land and then get it all the way up to the lockup stage. And then you'd get your first draw of $119,000 at that stage. And so you can see the peak capital is still in the very beginning. It's still getting up to the lockup stage. But at this point, you're not getting a land draw because the land value is much lower. And because the cost to complete the construction exceeds the total lending amount that you can get on the project. And so, yes, the land value being different does affect how the draw schedule works. And so my advice or recommendation is just to get a copy of that spreadsheet and then just to play around with it. I was about to say that it's really fun to play around with it, and then I shouldn't say that because I'm a nerd and I like using Excel spreadsheets, and I shouldn't just assume that everybody else here is the same. But you can definitely use that and play around with the numbers yourself just to see what things look like. I had another question in the Q&A here. Michael is asking, the existing property is a duplex and there's a permit to build a 3-story addition at the back. How does the financing work? So if the existing property is a duplex and you have a permit to build a 3-story addition, you're probably going through construction financing to build that addition. And so in that case, they would just look at how finished is your product right now overall. And the reality is, if you already have a duplex and you're just building an extension or addition to the back, well, what total, if you're 0% of that addition, but 100% done on the duplex, then maybe you're right now at 70% complete. And so they would work out a draw schedule based off of you already being 70% complete and then kind of build it out from there and figure out what your draw schedule would be based off of that. So it would still probably do that as a construction mortgage. The other option is that you just do a big refinance today in the current value and then try to use those funds to just build the addition. As I mentioned earlier, though, if you are making structural changes to the current duplex, you may be considered in breach of your current mortgage contract. And so I'd implore you to get legal advice before you do that. Cool. I was going through the chat here to see if there's anything else. Let's see here. Yeah, I just answered Michael's question. That's good. Jesse would like to have an email of the recording. Yeah, that's good. John is looking at doing a joint venture with someone who owns the land. Appreciate the spreadsheet books. Yep, no problem. And just make sure you email my team at info@greenmortgageteam.ca for the book and whatnot. And we'll make sure that we send an email out with the spreadsheet in the next 2 days. Surav has a question: are the credit unions flexible with GDS, TDS compared to the banks for residential construction? Not really, actually. The credit unions usually are just as rigid, or sometimes even more rigid, I find, than the banks on GDS, TDS. But what I do find is that they're a little bit more flexible in policy. So an example would be most of the credit unions right now are using a higher percentage of rental income from basement suites and other rental properties than major banks are. So you're going to find that some products are going to be a little bit more available for credit unions than banks. But at the same time, too, the GDS, TDS, I'm getting more exceptions on those with major banks than I am with credit unions. Like right now, most lenders go up to 44 debt servicing. HSBC is going to 45 pretty routinely. If a client has 100 grand plus in income, then Scotia is doing exceptions up to 50%, 48 or 50% debt servicing quite often. So it just really depends on the circumstance. Erica asks, do you have access to private lenders for construction lending? Are you a one-stop shop to figure out which route we should go for the build? Yeah, so we work with a lot of private lenders to find the best route. Sometimes we'll find that we'll put together 2 different options. Here's what a major bank would give you, and they might give you less money, but at a cheaper rate. Or at least you have to put in more capital in order to get through their draw schedule. And here's a private lending option where the cost is higher, but you need less capital to get through the project. So that's what we look at doing. And then June has a question: do you have experience funding special needs, seniors, or wheelchair project ideas? I've had a couple of clients that have been involved in that process, but usually that's not something that I get as involved in. However, there are some items within CMHC where you need a certain percentage of your building to be accessible according to the city bylaws and whatnot. So that is something that typically I don't get involved in specifically working the developer, but it is in some of the programs, it is one of the requirements for Cmhc construction financing. Anil has a question, get a copy of the spreadsheet, and we're going to email that out to you, Anil. So we're going to send that over along with the recording of this. Another question from June, do you have a way of raising equity for a $5 million exempt securities fund to invest in projects versus a MIC? I've helped with connecting people together. I'm not an exempt market dealer, and so it makes things a bit more difficult, but there are sometimes ways that I can still help with people that are raising capital. So I think that's a conversation that we could have on a one-on-one basis to discuss how we might be able to work with each other on that. Grant has a question. We are based in Ontario and have several development projects we are working on. Can you support and help us with financing from BC? Yep, for sure. We do a lot of stuff. Ontario is probably the second biggest province that we do business in, and at least 10 or 15% of our overall book is in Ontario. So we do a lot of business in Ontario. And if we find that there's challenges where we need to use a local credit union that we don't use a lot or whatnot, we've got a ton of mortgage brokers that we work in Ontario and a lot of colleagues out there. So we're happy if it looks like at a glance that it's something where maybe a local person is better for that, then we're not going to sit on it and drag that thing out. We'll refer it out to a local mortgage broker if we think it's better suited for them. But I will say that most of the stuff we do is with major banks, and they're across the country. It doesn't really matter where we're located or where you're located in most cases, unless it's very unique in nature where we might be needing to use a local credit union for some weird reason. And last thing, Erica just mentioned, schedule a chat in the new year. Yep, perfect. All right, guys, awesome. I think that wraps up the discussion. I can see that the number of participants is still 80 people, so you guys are still hanging around. But thanks so much for attending. I really appreciate everybody coming out, and I hope you found it informative. Remember that the next webinar is going to be the first Wednesday of the month, so that will be November. I guess it's November 3rd. I think, yeah, November 3rd at 7 p.m. again, and we'll be going into commercial financing. So we're going to go into a lot of details on that. So looking forward to seeing you guys at the next one. Thanks a lot. Have a good night, guys. And Human, you can sign up for the webinar on our website. We'll be putting up those instructions shortly. Thanks a lot. See ya.